On this week's episode of Market Talks, we have Huff, the founder of Pear Protocol, an innovative new DEX launching on Arbitrum later this year. Huff has worked as an equity derivatives trader for various investment banks for over a decade and has been full-time in DeFi since 2019. He is often quoted in various news outlets for his views on the markets, which he shares in real time on his Twitter. All right, so Huff, thanks for coming on to the show today. I really appreciate it. I think the insights that you're going to share with all of our listeners are going to be quite illuminating. So let's talk about markets from the highest time frame possible. What's your current view on the crypto market within the context of just crypto, and then within the wider context of US macro and global macro developments? How are those impacting your current thesis on the crypto market?
Perfect. So I'd say crypto is a closed system at the moment. There's not any new money really flowing into the ecosystem. And so what you're seeing is a lot of rotation between different narratives. So whether it's meme coins, whether it's LSD-Fi, whether it's Gamble-Fi, whether it's activity on Optimism or Arbitrum, or more recently on Base, it's the same pool of capital that's rotating around, looking for a hot new narrative to jump on. And there's a couple of metrics that point to this PvP environment, one of which is stablecoin inflows and outflows. So there's been net outflows of stablecoins from the ecosystem. The amount of money TVL in DeFi, as tracked by DeFi Llama, has been trending down over time. And then the half-life of each narrative is shorter and shorter. So if you compare to 2020, 21, where you had Solana, Avalanche, and Luna, these kind of three layer one theses, and that played out for over 18 months. Now your average narrative lasts anywhere between a day and a couple of weeks or months at best. And so my current view within crypto is it needs a fresh stimulus. Obviously, we can talk a bit about the ETF, we can talk about global macro, but the way I see crypto in the context of every other asset class, which was the second part of your question, is that crypto is like a vacuum for excess global liquidity. And what I mean by that is when rates are low and there's lots of money sloshing around the system, people are spending more and they're looking to take more risk. And the way that manifests is firstly in the equities market, secondly, maybe through kind of non-fungible items like collectible cards or art or whatever, fine wine and consumer products. And then lastly, crypto. And so you've seen this in 2017 and 2020, when there is excess global liquidity in the system, either through monetary or fiscal policy, so either through lower interest rates and bond purchases, or through the government simply handing out checks to households and giving tax rebates to people. That's when crypto really thrives, because it is, like I said, a magnet for that excess global liquidity. Right now, liquidity is tightening, and the Fed have been increasing rates and removing liquidity for the past 18 months or so. You're starting to see that in consumer credit markets, right? You're starting to see this liquidity crunch in terms of how businesses spend their money, how households spend their money. And so in that context, especially with all the negative press around crypto, it's not going to attract the liquidity and the volume to really have this second wind unless a fresh catalyst presents itself. So my current view is that crypto will remain subdued for a period of time. It's already been bobbing along for the past few months. I think we are still in a quagmire for another 6 months or so. I think we will see more lows in the equity markets. I think we'll see some more pressure in the bond markets. I think the effects of monetary tightening are yet to be seen in economic data. And I think in that context, crypto still needs to bottom. It's forming a bottom at the moment. And I do think Q1 plus next year is very bullish for all assets.
Fantastic explanation. I want to unpack a few things that you've said there, especially around narratives driving crypto price action, investor sentiment, investor actions, and rotation within, what you've described as being a closed system in crypto. So how does one, either a trader or even a builder, make fundamentals-based investments in a space where narratives catalyze all capital rotation?
Amazing. I love this question because my day job, I'm the founder of something called Pear Protocol, and Pear Protocol enables narrative trading, right? So where you're long one asset and short another. Let's pick a really prime example, the flippening, ETH outperforming Bitcoin. How do you get a sense of whether the flippening, ETH outperforming Bitcoin, is going to take place? Or even something more esoteric like Lido outperforming Rocket Pool as a narrative, right? Narrative trading is all about collecting data. Now, there's a few ways you can do that. You can do that through sentiment analysis. So you can use AI tools to do sentiment analysis of social media. How many times is something being mentioned on Twitter? Who is engaging with that content? How often are the hashtags being used? What are the trends there? You can look at more fundamental trading data like the open interest or the funding rate. Even the price action, and see what narratives are starting to form. That can be in the form of centralized exchanges and getting the data from Binance or OKX or somewhere, or CoinGlass, or it could be more fundamental, looking at research reports by Masari Mainnet, Delphi Digital, Blockworks Research, those kind of places as well. So to really keep on top of narratives is quite a full-time job. I'd say you've got to span different data sources, including speaking to people. Conferences are great for exploring new narratives, speaking and connecting to people that are research analysts or venture capitalists in this space, or even hedge funds in this space, is great. I'll give you some examples. Some of the narratives I'm looking at for next year include decentralized compute. So there's a global shortage of GPU capacity, so processing capacity, and graphic cards. Can tokens like Render or Tau, or even Akash Network fill some of that? Well, Masari Mainnet have written a lot of research on this. When I go to conferences, I speak to people about decentralized computing. I then mirror that and look at some of the analysis on those tokens. I may go away and read some research reports. And so narrative forming and reading about narratives is very much a research-driven role. I would say this about narratives: the minute you start to see Twitter threads being written, you're probably slightly late to the narrative.
Yeah, especially if they are repeat Twitter threads where they're copy pastas of the original person that said it. I agree with you. Things are starting to play out. Like they're starting to terminate and you're basically at risk of getting dumped on. I want to go back to something you said earlier about crypto being a closed system where we don't see a lot of monetary inflow right now, and that, you know, the capital's just rotating from one narrative to another via smart money traders and euphoric retail traders that are chasing after outside gains, but no new money is really coming into crypto. I assume that the consensus here and within the crypto space is that either a better regulatory framework or the eventual approval of the long-awaited spot Bitcoin ETF is what will catalyze all that inflow from the institutional side and thus also the retail side to come back into crypto, and then we truly get another bull market. That's kind of the base case that I hear all the time. But based off of what you said earlier, I get the impression that there's two different schedules or paces at play here between these industries: the real economy versus the expectations of crypto investors, or you could even say the crypto industry, right? So a narrative driving crypto right now is the 4-year halving cycle for Bitcoin.
Yes.
And then other traders are looking at historical fractals, and they're looking at price action, and they're looking at market structure on the weekly, monthly, and yearly time frame, and looking at the past other historical data, on-chain data, to kind of inform what is going to happen in the future, in the next couple months, in the next year. And you've seen that shift in kind of like group think, right? Or the hive mind. Like everybody is now talking about low volatility being an eventual catalyst of a sharp directional move for Bitcoin and Ethereum. Everybody's talking about how many delays will there be with the Bitcoin ETF before we eventually get an approval. I mean, it's everyone's literally talking about the same thing, which to me says things have shifted in terms of where we expect crypto to go in the next 12 months. I would say like 90% of people expect a bull market just based off of this groupthink. But that trajectory, this time frame that crypto investors have mapped out for where crypto and the industry is going to go is somewhat, it's moving at an accelerated pace when compared to like macro and equities, right? So contrast the expectations of crypto investors against lagging indicators of economic health, like consumer spending appetite, current mortgage rates, both in the UK and USA, like they're super high. car loan approvals being at record lows, layoffs accelerating, credit debt being, at an all-time high in the United States. Those two things are going on, right? Like the economy's strong now, but you still have a lot of analysts that are like in Q1 2024 and Q2 2024, we might get a recession, right? So talk to me about kind of that these two markets are out of sync. And despite this, you've said that you're really bullish on quarter 1 of 2024.
Yeah, great question. So I think you're right. There's a real sense that crypto is going to be bullish next year, right? And I'm definitely caught up in that zeitgeist and that belief that we'll have a very bullish year next year. I think part of that is because in crypto alone, all the bad news has been absorbed by the market, right? We've had FTX, we've had the DOJ come against Binance, we've had all these CeFi implosions, whether it's Voyager, Genesis, BlockFi, etc. We had Three Arrows Capital and Luna. And I think the reason for the optimism in crypto land is, hey, like things have really, really been through the mud. Like how much worse can they get if even we're contemplating the breakdown of Binance and Tether, right? If this industry can still survive all of those, then surely it's upside only from there when some more risk appetite and some more money comes into the market. With regards to equities, bond markets, and global macro, at the same time, you're right, people are tightening their belts and there is this expectation of a recession next year. Now, an environment that can work for crypto is the following. We kind of muddy along Q4 the rest of this year. The market then does decide to turn lower in the world of equities and bonds. Interest rates do go higher on things like treasuries, and you do see some of this economic data start to get a little bit worse in terms of GDP or consumer confidence or whatever it might be, right? At that stage, as you're tipping into a recession, the Fed have a terminal funds rate of between 5 and 5.5%, right? There is the potential for them to then stop, do a Fed pivot from raising rates. There's a potential that the market could become deflationary in nature, and there may also be room for interest rate cuts at that stage as well. So the fact that global macro can get worse, but crypto can get better, I don't see that as a conflicting dichotomy. I think that those two can sit very well with one another. And it plays into the point of liquidity. Right now, there's no liquidity in the system. But if things get so bad that more liquidity does need to be injected into the system, then you might see some rotation between like equities and crypto, for example. People taking some money out of equities and into crypto, or even out of bonds, which have been yielding you 4.5%, 5% on treasuries, and into crypto. And so on a marginal level, I do think that there's scope for money to flow into crypto, even if things turn worse on the macro front.
What sort of things do you need to see happening in order for central banks to start cutting rates?
I think we're a long way off from cutting rates. I think we're definitely closer to pausing. I think central banks need to see, and they've said it very, very well, right? They need to see a sustained downtrend in inflation as measured by CPI. We're currently nowhere near their 2% target. I think also the labor market is very, very tight. Any kind of slackening in the labor market would help them in some way do that as well, because it removes the pressure of wage price inflation. And so I'd say central banks need to see things to get worse before they can actually decide to reduce rates, not better.
Would you say that your comment that you've made earlier about crypto being a closed system and there's not a lot of inflow at the moment, is that sufficient enough to kind of answer the question about this record multi-year low volatility that we're seeing in Bitcoin and Ethereum price action?
Yeah, so volatility manifests in two ways, right? There's natural volatility just from buyers and sellers of spot Bitcoin, which, yes, you're right, it's a closed system and there's just less market participants. So volatility is going to be lower. You don't have the big buyers, you don't have the big sellers coming in, and so volatility will be dampened. And then secondly, is more structural in nature. Like there are a lot of funds now who are just selling crypto vol because there's no upside or downside catalyst. And compared to equity markets, crypto vol for a long time has still been relatively elevated. So I'm quite close to some of the biggest market makers on Deribit, one of the biggest options markets, if not the biggest options market in crypto. And the kind of hedge funds that have been selling vol consistently there for the past few months it's been a free lunch for them because they've looked at this market post FTX. They've seen that there are very few catalysts for volatility to go up. The implied volatility on Bitcoin and Ethereum call options was still in the 30s and 40s. They can sell those call options, hedge it fairly well, and earn a nice premium for selling those overpriced call options. And so you've got a fundamental reason for low volatility, which is just less volume on spot exchanges. And then you've got a technical reason for that, which is systematic selling of call options.
And that's what's constricting ETH and Bitcoin price basically within these tight ranges.
Exactly, because if there's no new volume coming into the market and then an options dealer is just selling a whole bunch of call options to people and hedging their delta by just selling like ETH futures or Bitcoin futures, then that's going to manifest as range-bound markets.
So recently, Real Macro host Raoul Paul said, debasement mutualizes the cost of debt on income earners and rewards asset owners. According to him, this is a big issue. He says that you need to own assets, and the only ones that seriously outperform debasement are secular trends, to which he says are crypto and tech. What's your point of view on all this?
Great question. So first, let's do some clarifying some terms here, right? So debasement, he's basically talking about inflation here, right? And inflation is a hidden tax on people. Because let's say, Ray, you have $100 in the bank. And let's say, unfortunately, today that $100, it goes out, you can buy it, you can fuel your car, you can buy a Big Mac, and you can maybe have a beer in the evening, right? Let's say you were unfortunate to go in a coma and come back out 10 years from now, and you had $100. Well, $100 10 years from now might only buy you enough to fill up half a tank. It might mean you can't afford the McDonald's and you certainly can't have the beer anymore in the evening. So your purchasing power has decreased, right? The dollar has debased from that initial $100. And as someone who has that $100, your purchasing power has gone down a lot. Now, that problem, the only way to counter that problem is to own assets, because inflation is a hidden tax on people. They lose their purchasing power over time. However, if you had that $100 in your home might have gone up to $120, right, in value. Or $150. I'm simplifying massively here. Or had you put that $100 in equities and come out 10 years later, you might be worth $200. And $200 now can buy you, fill your tank. It can get you that McDonald's, and it can buy you that beer at the end of the day. Raoul Paul's argument is that the dollar is being debased on an unhinged level with unprecedented levels of inflation. I'm not talking about the amount of inflation that's reported at 4%, 5%, whatever. Like genuine, real inflation, if you look at the price of houses, or if you look at the price of trains, or the price of food, like there's a real dichotomy between what gets reported, which is what the government decide is the metric of a basket of goods that represent inflation, and then real inflation that real hardworking people feel on a day-to-day basis, right? The cost of living. And in that context, you want to own assets. And what assets do you want to own? Well, you want to own traditional assets like land, like property. You want to be long tech, because tech is forever throughout humanity been a one-way bet if you get it right, whether it's the printing press, whether it's the steam engine, whether it's technology in the form of Microsoft and operating systems, or whether it's tech in the form of AI. Like tech has been a one-way bet, and tech doesn't mean Apple phones. Tech means technology that moves humanity forward. And crypto within that has an even more unique space, because crypto is a relatively new asset class. It has these kind of speculative elements to it, but it does combat inflation very, very well. On an inflation adjusted basis, there is no better asset than Bitcoin over the past 10 years. And so I'd say he's broadly right. You want to own assets. Crypto is just one of the assets that I would want to own. But within crypto, you have to be very specific, right? Like if you want to hold something in a strategic way, hold Bitcoin and ETH, because I can't promise you as to whether, and nobody can promise you as to whether Solana or whether Optimism or whether Dogecoin or whether like any of this long list of, for the large part, rubbish tokens that don't need to exist is going to hold its value. But stuff like Bitcoin and ETH, absolutely. You want to be the owner of tech, you want to be the owner of assets, and inflation is a real problem for people, which you have to have plans against. It creates huge inequality, right? The asset owners over the past 5-10 years have got very rich. But if you're a 22-year-old out of school, then that increase in prices is terrible for you, because you can't buy a house, you can't buy a car, you have to rely on your parents being wealthy. And so, as a young person or relatively young person myself, I'm 34 now, I'd say you definitely want to be long those assets.
Right. That makes sense. So, a few quick fire questions. On a 1 to 10 scale, what's the likelihood of a Bitcoin spot ETF being approved before the end of 2024?
So before the end of the year, so the reason why you're asking me this, I think, is because I talk about this all the time on my Twitter. But by the end of this year, I'd say 30%. I'd say by the end of Q1 next year, 80%.
Wow. Okay. What happens first? Solana price to $10 or $80?
I think $80.
Okay. Liquid staking in DeFi, is it another boom to bust cycle or the key to DeFi's future?
I think it's the key to ETH's future. I think anything that is yield generating is very appealing for longer term investors. And the way that I know this is a quick fire round, but the way that somebody explained it to me very well recently is if I'm going to hold an asset for 10 years, the compound interest of holding ETH and then reinvesting the staked ETH returns will outperform Bitcoin just from a compound interest perspective, never mind price appreciation. So I think liquid staking has a lot of institutional mindset, people that really understand compound interest over a longer period of time.
Fed interest rate cuts happening in 2024 quarter two or not?
Very specific. So definitely not this year. And I think things have to get worse before they get better for them to cut rates. So I'd say yes in 2024, but not in Q2 or earlier.
All right. Well, Huff, I appreciate you coming on today. Thank you for your time. But hey, man, it was great talking to you, and that was a fantastic conversation.
Thank you so much.
All right. Well, have a good one. Have a nice evening.